A lot of our sponsors have a lot of their own money they can raise through friends and family, but investors get tapped out. If a sponsor has 2 good deals in a period of 6 months, oftentimes a lot of their investors may just not have the liquidity to reinvest a second time.
You're listening to Alternative Investor Mastermind, where we do a deep dive on alternative investment opportunities and the lifestyle it can create. Join Jack Krupey as he presents actionable tips and tricks in doing passive real estate away from mainstream strategies. Go beyond the usual fix and flips and try less explored yet rewarding investing ventures, from multifamily properties, mobile homes to cryptocurrencies. Do not miss this opportunity to escape traditional assets and finally create wealth without Wall Street. Now your host, Jack.
Hey everybody, welcome to another episode of the Alternative Investor Mastermind. Today I want to talk about the dynamic of operating partners or syndicators and how capital raisers or fund of funds or allocators, which JKAM investments can fall into a few of those buckets, actually works. So if you're an operator, you need to raise often $5, $10, $12, $15 million in 60 days for a deal. And when I got started in this business, I actually just started as a passive investor. I was living in New York. I was paying a 50% tax rate, and I was looking for alternatives for passive income for myself and to earn income in a tax-efficient way. So I just started investing and getting to know these sponsors myself with my own money across a few different deals. And over time, as my career progressed and as I had my exit from my prior firm, started looking into investing more and more of my own capital. And what I came to learn from interviewing and talking to a majority of the sponsors and operating partners that I was invested with is that it's a constant struggle to raise capital. Even very successful operators, just because of the time crunch, often are scrambling to raise money. And there's also a lot of internal operational time and energy as well. To raise $10 million from a bunch of people investing $50,000, there's work on just talking through the deal, going through the operating agreement, answering questions about taxes, answering questions about the economics of the deal. And it takes hours and hours of time to work with investors, even though it's largely, I know for me, very enjoyable to do it, but it is just very time consuming. So operators that have investors who could write larger checks is obviously more efficient for them. And because of that, they'll provide better financial incentives, which could be anything from a better profit split to lower management fees to a higher preferred return. And ultimately, most of these investors, will value that and will really provide incentives for those that can, write larger checks. There are a few firms that really try to do things on their own, but I think largely real estate is a team sport, and a majority of sponsors are very interested to work with anyone who could work together with them to raise capital. Now, there's some legal ramifications as well. It's actually not allowed to just pay someone a referral fee for raising money. And, that's why, at JKAM, we're, I sometimes use the term fund of funds, but I don't know that that's like the best representation. It's really, we're really a co-GP fund, because we're at this point not just a passive investor. We may not be in the property manager office or swinging a hammer, but when we are getting involved in deals, we're working in general from the start, from the time the building is about to go under contract to review the numbers, in some cases advise on the structure, the optimal preferred return, the optimal profit split, what's fair in today's market, and really how to position the deal for a base of investors. So for that, we're often provided a piece of the general partner side of the deal. There's a lot that goes into being a general partner. Capital raising is certainly a big component of it. Also, there's finding a deal. There's the property management side, the ongoing asset management side. There's often net worth requirements that are required by banks that of the people in the general partnership need to have a certain amount of net worth, and also even just a certain amount of liquidity, just money in the bank and stocks and bonds, as opposed to real estate holdings. And a lot of operating partners are not as liquid in stocks and bonds because they have all their money tied up in real estate deals. So often having an extra partner that just has some capital in the bank, and this is not to personally guarantee. Almost all of these loans are non-recourse loans. But with that said, if you're on the GP, if a deal fails, you're going to have a very difficult time getting another loan, regardless of if it's personally guaranteed or not. So it's still a very big commitment to sign on a loan, and in some cases you earn pieces of the GP for that. So as far as some case studies, we've been doing this for, I've been investing in these deals for years, but JKAM formally has been doing this for over 2.5 years now. And we've built a great network of operating partners. There's over 15 groups that we've made co-investments with, and most of them we've done multiple investments, and that's really across a broad amount of the Southeast and the Sun Belt. We've invested in Augusta, Georgia, Jacksonville, Florida, Atlanta, Greenville, South Carolina, Charlotte, North Carolina. We've done Phoenix, Dallas, and Vegas with a number of complexes. Houston, which we've just put a lot of content out. We really love Houston, and then some random markets in the Midwest as well. Dayton, Ohio. We're really opportunistic, and we really follow the sponsor first. And each of these sponsors has typically 1 to 3 target markets, and they're going to look at 200 plus deals a year, and likely find maybe 2 or 3 deals a year. And of those 36 deals, we get sent way more than 36. But for simple math, of the top 36, we may do 12 to 15 deals a year. So it really allows us, and one of the benefits of not being a direct operator is, it allows us to see the best of the best, and really be efficient with our capital as well. To be an operator, you might spend hundreds of thousands of dollars in pursuit costs just to find that one deal. And so, for the JKAM funds and opportunities, we have very low overhead because of that, because we don't need to be spending hundreds of thousands of dollars traveling to properties, doing all the upfront due diligence. By the time the deals come to us, the sponsors have already done a lot of diligence and provided us a lot of materials for us to do our second level of due diligence and review the deals with the sponsors. So from that sponsor perspective, they've spent all that time and money already finding the right deals. Then they're on a real time crunch to get them closed. So knowing that we're there and that we're consistently there in a programmatic way. A lot of our sponsors have a lot of their own money they can raise through friends and family, but investors get tapped out. If a sponsor has 2 good deals in a period of 6 months, oftentimes a lot of their investors may just not have the liquidity to reinvest a second time. So there's a constant need for additional capital to be raised, and new investors to be brought into the ecosystem. And we love to be a part of that. Couple of interesting, really strategic ways we've collaborated with operating partners is we had a closing last summer on our property in Jacksonville, and the way the capital markets were at the time, our partners decided to put almost $5 million extra of their own cash into the deal at closing. So they closed with a lower loan to value and less debt. And because of that, we had a deal that was open to continue to raise. And we'd already put our initial capital in over the summer, and then we moved on and we're looking at a couple other deals. So when we had our monthly meeting with the partner, we looked at the capital stack and we looked at the numbers, and rents are up significantly. So we actually went back out and kind of re-engaged on the property to put in additional money from our fund and also market the deal directly as well as part of our being part of the GP through a co-GP relationship. And towards the end of the year, there was a lot of tax benefits. It's the last year of 100% bonus depreciation. So, as we were talking with our investors, we said, hey, at this moment, this is one of the best opportunities out there because you can still get, and we're targeting roughly 80% bonus depreciation for 2022. Even if you come in at the very end of the year, you still get, the entire bonus depreciation check. So that worked out really well. And we had 6 months of financials to show already that show that the rents had grown significantly and that, overall the property was performing really well. So our investors really appreciated that, that look under the hood, if you will, to really understand the numbers and how they were advantageous. We also will work strategically with partners, those that are looking for larger checks. We do have a network of family offices, and we also, do some work on the 1031 exchange front. This is really an informal type of arrangement, but we have investors. If we know we have investors that are about to sell something, we can work together to try to place them directly into a deal that we've already reviewed and vetted, and with a partner that's proven to us. And because of the intricacies of the 1031, it's typically done as a tenant in common, and those investors typically will invest alongside JKAM and alongside the operating partner and own a direct piece of the deal. So it actually complies with the 1031 exchange rules and allows them to defer all of their capital gains into the new transaction. We're currently working on a deal in Houston, and given a lot of the changes in the market, we've really looked for creative and interesting opportunities to add value. And so we have a deal in Houston that has a 2.5% interest rate that we're going to assume. And the going in cap rate, if you look at the last 3 months of net operating income, is over 5. So that's a huge spread. There's a term called negative leverage, and in recent months, really up until rates moved, a lot of the properties were actually in a negative leverage situation, meaning you might have an interest rate of 4 or 4.5 and a cap rate of 4. So you'd actually have a higher interest rate than cap rate, and that's not a great spot to be in. It does happen sometimes on heavy value adds just because there's so much upside built into the rents that you pay a premium on the cap rate because the income being shown is really not going to be the income for long, and ultimately buyers will pay a premium because they really look at it not quite as new construction, but in new construction there's a concept of what cap rate are you building to. So on a heavy value add where you're going to raise rents significantly, $300, $400, $500 a month, you may look and say, okay, well the current cap rate is 4, but 6 months from now, we're going to be at a 5.5 or 6 because we're going to raise rents significantly and renovate units. So, but going forward with these higher rates, cap rates are adjusting, but they have not moved as much as the interest rates, at least on the short term for the 2-year. If you look at the 10-year, the 10-year's moved, but not quite as much. And I think the long-term typical buyer for many of these complexes is a more of a family office or an institutional buyer, and most of the buyers will work off the 10-year debt. So, because of that, I think cap rates will not expand nearly as much as the interest rates have. And had a conversation with one of my mentors in a group we've invested in a number of deals with, and he said even if you're an institution or you're a large long-term family office buyer, if you have the choice of buying treasuries at 5% right now, that's great, but that's for 1 or 2 years. If you buy a building at a 5% cap rate, you have, even if you paid cash for it, you're getting, for the next year or two, you're getting roughly the same rate as treasuries, but you have a long-term appreciating asset. You have an asset that you can leverage smartly at the right time. And that's what a lot of the deep-pocketed buyers are doing, is taking either much lower leverage or in some cases just paying cash and taking the current rate of return as something very similar to treasuries, knowing that they have the option in the future to do a cash out refinance and also take advantage of the tax benefits as well. treasuries, unless you're in some type of municipal bond, which is certainly not a treasury. Have tax implications from interest, whereas real estate does have losses through depreciation. Lastly, I just want to go through how things typically work. We're engaged usually at the start of a project pretty early on, where we get to really look at the deal, understand the game plan, and we work very closely with our partners. We'll typically put out our own emails, or a series of emails explaining the deal. Sometimes we do an actual webinar. Sometimes a lot of our investors have actually liked the one pager we put out, just called "Why We Like the Deal," where we'll just put key highlights together. And often there's a 2 or 3 week period to round up capital and invest in the deal. So we're answering email inquiries, we're jumping on phones. I've got a number of investors that I have a pretty good idea of what they know, what they want, what their questions are. So, for our recurring clients and those clients we have a really close relationship with, we'll often tee up a custom email or report and just tell them about the deal and why we think it's in their wheelhouse. And investors have two choices of how to invest. We have our diversified platform, diversified fund, that actually continues to invest in each of our opportunities, so that if you invest in the fund, you own a piece of every prior deal that's in the fund, but we'll also continue to acquire new properties in the fund as capitals continue to raise. And we keep that fund open from generally 1.5 to 2 years. And then we will close that fund and then start a new fund. And then just, any future sales that happen in the prior fund eventually just return capital. And, it's a great way to have money in motion for 3 to 7 years and have a diverse base of assets. And then we have a second platform that actually allows all of the economics to be segmented. So if you only want exposure to one deal, you can then expose to that one deal. And then what those funds do is those funds will invest directly with the operator. So the benefit to our partners there is they receive one check or two checks from the JKAM funds. And JKAM is the only investor that they face. And so they only have to send one tax document to us. There's only one there's one agreement to sign per fund. And they send, they'll send us one large check. And then if it's the fund, obviously, the diversified fund goes into the pool of the other investments. If it's the direct deal platform, if we have 5 investors co-invested with us, we will just disperse that money accordingly. And lastly, we're almost always getting preferential terms. In our diversified fund, we actually give any co-GP to the fund itself. So the diversified fund ends up making a higher return than if you invested directly, because we receive, in some cases, better economic terms just for writing a larger check, but also nearly all cases we're getting a piece of the general partnership of the deal because we're actively involved in the deal. And then in our direct deal platform, there's often also preferential terms. In some cases, it's even just access. There are some offerings that have a $500,000 minimum, and because we're pooling capital together through our funds, you can get in with as little as a $50,000 minimum. So all in all, it's a great win-win. It gives our investors access. It gives our investors better terms and returns. And from the operating partner perspective, it saves them a lot of time and efficiency. And it also, just gives them a strategic, recurring, programmatic investor that they can rely on. When we're involved in a quality deal, they know that we're going to be part of their team to work together to bring in our tribe of investors and invest through our fund and just ensure that the project meets its deadlines for raising capital for closing. And ongoing, we have a seat at the table to review the best strategic options for growing profits for the property and eventual sale. So hope this was helpful. Please remember to give us a review on iTunes. I would love a 5-star review if you like what you're hearing. Subscribe to our YouTube channel. Follow us on LinkedIn, Facebook, Instagram, all at jkaminvestments.com. And hope to see you in the next episode.
That's all for this episode of Alternative Investor Mastermind. Now that you know the many alternative opportunities out there all up for the taking, You can finally become ultra connected and ultra wealthy. Get more valuable advice from the experts by subscribing to the show at AlternativeInvestorMastermind.com. Become a winner in the world of passive investing today in alternative investment strategies. Thank you for joining us. Until next time.